This was one hell of an article. So there's this company called eToro, which allows speculators to piggyback and copy other people's trades. So it was somebody wrote, "Think Facebook meets E-Trade." You read this?
Read the first two paragraphs of the lead here is perfect.
Jay Smith isn't a professional money manager. He's just a 32-year-old living in Southern England who spends his days playing the stock market. But Smith, better known online as Jay Nemesis, drives the investment decisions of more than 21,000 people with $40 million in assets who copy his trades on a digital platform called eToro. When he loads up on shares of FedEx, so do they. And when he shorts the NASDAQ index, they do that too. So how does this work? eToro pays people like, what's his name? Jay Nemesis. They pay him 2.5% of the assets that follow them. So this guy Smith is pocketing $1 million. His portfolio is up 62% this year. So he's getting a ton of people following him.
So to me, this sounds like a more organized version of Reddit to me, where you can follow someone's trades. And I'd never really heard of this before, but I guess you can basically hit a button and say, I want to follow the trades of these 5 people.
To me,
I've seen their track record.
To me, this sounds super dangerous.
Oh yeah, definitely.
Right.
Because especially in the trading game, like maybe this guy is a good, like there obviously are good small investors out there that you've never heard of, but there's also a lot of them who got extremely lucky.
So that's the
you're
point.
Gonna hit a button and follow someone who got lucky for 18 months.
Right, exactly.
And then see you later.
Yeah. Holy moly. This is a disaster
Yes.
waiting to happen. So this is not available in the United States. I don't see how we allow this.
They said that they're going to try to come in here in early 2021 and challenge Robinhood. I mean, this is, I don't know, maybe this is the kind of thing where it worked there, but it's hard to implement somewhere. Like if Robinhood did this, don't you think there's got to be well-known people that they would follow? But yeah, I'd be interested to see if people actually take hold of this because it's what, and this guy's making $1 million a year.
So the incentive for the people to swing for the fences is obvious, right? Just take as much risk as possible because if you get lucky, then you can shoot up the scoreboard. But then the idea that there's going to be noob whales who follow these lucky people is scary.
Yeah, and honestly, this happens with this is not just these traders on platforms like this. Even the best professional investors in the world have periods where they get kind of lucky for a while and then fall off the face of the earth. So to follow amateur traders into this stuff, yeah, you're right. This is, I'm sure they have as many lawyers as they need and as much paperwork and legal fine print on this stuff, but there'll be people who are probably going to get harmed investing in this kind of stuff.
So last week we interviewed Berta Malkiel, and he had a great answer on why markets aren't perfectly efficient, why the prices obviously aren't always right. I don't know anything about Dick's Sporting Goods, the business, but this thing was at around $50 before the pandemic. Obviously, its business model was decimated, so it fell from 50 to 13. Okay. That makes sense. A 75% decline or whatever it is. That makes logical sense. Now the stock is at $62. How is, again, I don't know what they're doing, but how is Dick's in a better position today than they were 9 months ago? And again, that's only according to the stock, which my point is, I'm not saying this is obviously wrong. I don't know, but this seems nuts. No?
Yeah. Well, yeah. You could argue that they're going to make a bigger push into online retail and e-commerce and that sort of stuff. But that's the kind of arguments you hear from people. They say, okay, Dick's was worth 50 here, then 13, now 62. Efficient markets, ha ha ha. And Melchiel's point was, no. The point is, no one ever knows what the right price is, really,
right.
Because opinions are changing all the time and expectations. And so if you're sitting there at 13 and going, yeah, that price makes sense. And then you're sitting there at 62 saying, yeah, that price makes sense. No, maybe they all don't make sense, but people are constantly changing their expectations so much that it's hard to know which one of them is the right price.
That's probably a pet peeve of mine. People that point to individual stocks doing crazy things and then laugh at the efficient market hypothesis.
Right. Okay. If you would have done something about those prices, then you can say, yeah, markets aren't efficient.
If you're so smart, go on eToro and make $1 million a year.
Yeah, with a really great username. All right, one more. one of the first investment books I read was Howard Marks' Mastering the Market Cycle, which then led me to Ray Dalio and so on. Their teachings on economic cycles became so ingrained in my head that I can't stomach purchasing my first home. What if they are correct and should be the end of an economic cycle? In 2018, Ray Dalio was on record saying we were in the 7th inning, which feels like a lifetime ago. I've been sitting in a 6-figure pile of cash since 2018, allocated for a home purchase. That's 3 years of waiting. My fiance and I are getting tired of waiting, and now she's demanding a better housing situation. She wants to buy, he wants to rent somewhere else nicer. He plans on meeting in the middle. I think this is one of the reasons that buying a house is not an economic cycle choice. It's just not, like, thinking in terms of I'm going to buy in the depths of a recession or I'm going to sell because things are toppy. That's just not the reason you make this decision.
What if you buy a house for $450,000 and you're happy with the house and you want to upgrade in 10 years and the house is $430,000? Okay.
Right. That 10 years to you
that's
of
your
memories made.
Right. So yeah, Ben's absolutely right. Now, the other side is it's really hard for this person who has been waiting for 3 years to all of a sudden dump the money. So I get it. It's tough. This is why sitting in cash is so hard. In theory, it sounds like a good idea. You're going to wait for the fat pitch. Well, we kind of just had it. I know it was quick, but it's poison. It really is.
And everyone knows that you buy a house when we're in the 4th inning, not the 7th inning. But I don't know if I'm trying to picture this conversation between this guy and his wife, and I'm trying to picture me bringing up Ray Dalio and Howard Marks to my wife when we're trying to buy a house, and her thinking like, no. But yeah.
But honey, it's 1937.
Yes, again, this is why I just think using these economics, like it sounds so intelligent in theory, but again, if you would have told someone following the last crash that, guess what, during the next recession, when stocks are falling 35%, we're gonna be living through a housing boom. Can you imagine telling someone that?
No, of course I can't imagine that. This is from 2015. Dalio warns Fed of 1937 style rate risk. I mean, he's been talking about if 2015 was 1937, then that's not good because now it's 1942.
Ray Dalio and Howard Marks are billionaires. They've probably each bought in 6 houses since 2018, and it doesn't matter to them. So it's just, I think, especially
by the way,
your home,
I Googled Ray Dalio.
Timing is. Go ahead.
Sorry,
you're trying to caveat this.
No, macro timing is what?
When you're, especially with a house, it's the most emotional asset on the planet. In trying to use the macro setup to make your purchase, I think is just, it's never going to work. Yeah,
you're not Muhammad el-erian. I Googled Ray Dalio 1937, and one of the first images that comes up is a chart that you've done. Do you remember doing this blog post?
Yeah, probably in like 2015, right?
You wrote this blog post. You wrote this blog post in literally November 2017.
Okay, and that was in 1937?
3 years ago. Yeah.
It was possible.